Today we'll be quickly going over a few important factors that lenders will evaluate when applying for a mortgage. You might think lenders only care about your credit scores, but they actually look at far more than that. When you apply for a loan, expect them to thoroughly analyze your full financial profile. This includes your credit history, assets, debts, income levels, and more. Of course, your credit score is highly considered by lenders. After all, the credit score was designed to be a 3-digit representation of your full financial trustworthiness. But for a lender to determine approval and interest terms for a large loan, such as a mortgage, they're very, very thorough about it. Here's what lenders look at and why. Number one is credit history. In a way, your credit score is a compilation of your credit history. While this is true, lenders are still going to look at your credit reports to see the full records. Looking through those records, they'll be keeping an eye out for things like unpaid collections, past bankruptcies, foreclosures, delinquent accounts, recent inquiries, and outstanding debts. Lenders want to see your credit history as a whole and in a detailed manner. Number two, income and expenses. Lenders lend you their money so that they can make money. If you have a high income, you're more likely to pay your payments. If you have a low income, they may view you as less likely to make your payments on time. For lenders, it's all about risk. By analyzing your income and expenses and calculating them into your debt-to-income ratio, lenders get a better look at your risk factor. Keeping your debt-to-income ratio at 30% or lower is a great way to get the lenders on your side. Next is the down payment and loan term. With down payments and loan terms, it's pretty straightforward. Lenders see high down payments as lower risk. Similarly, lenders see shorter loans as less risky than a longer-term loan. If there is less money to pay off over a shorter amount of time, you'll get less interest. Stay within your financial capabilities, however, or you could end up doing serious damage to your credit score by missing payments. Fourth is liquid assets and loan collateral. As previously mentioned, lenders are in the business of making money. By checking your liquid assets, lenders can see if you have assets that can be quickly converted into cash. While you are expected to pay your loan off with your income, lenders will potentially give you better terms if you have assets to cover the loan. The same idea is why lenders look at collateral. Essentially, when you apply for a mortgage or an auto loan, the lender wants to see the value of the object because it will act as collateral for the loan. If you stop paying, the lender will always get their money back somehow. If you provide collateral, you're going to get lower interest rates and the lender will be pleased to provide those interest rates. The last thing we'll be going over today is employment history. Employment history is something that could very well be checked when you're applying for a mortgage. While lenders could approve you based on your current income, sometimes they prefer to check the previous few years of your career to assess your income stability. Being a job hopper or having a career gap could really raise some questions, while consistent employment will make you look great. Pretty simple stuff. Now you can see why your credit score is not the only important thing to pay attention to. Lenders care about your full financial profile, and so should you. Make sure you know what you're getting yourself into before applying for your next loan, so you not only get approved, but you get the low interest rates as well. Thanks for watching the video. If you have any questions, leave a comment down below for us. We're happy to help.